Disney, the entertainment, media, and leisure giant, needs no introduction. Since the 1970s, the company's share price has soared to a peak of $203 in March 2021. Let's zoom in to see that since then, the decline has been severe, with the share price hovering around $90. So what happened? Since the arrival of Bob Iger at the helm of the company in 2005, the group had been accustomed to success, fueled by major acquisitions such as Pixar in 2006 for $7.4 billion, the Marvel Entertainment franchise for around $4 billion, and 27% of the Hulu platform in 2009. The Lucasfilm Studio, owner of Star Wars and Indiana Jones, in 2012 for $4.05 billion. Then BAMTech, a streaming technology specialist, in 2017 for $2.6 billion. At the same time, it invested $5.5 billion in Disney Shanghai, the group's third theme park in Asia. So far, so good. Then the group took a strategic pivot. Disney started to take a dim view of the success of Netflix and Amazon Prime, which were nibbling away at the market share of subscription TV channels, including ESPN, the group's sports flagship, which saw an exodus of subscribers. First, Disney cut off its Netflix content in August 2017 and said it's working on its own streaming service. Then, at the end of 2017, the group set its sights on a very big piece, the takeover of 20th Century Fox Studios. The acquisition includes a network of 22 regional sports channels, the FX and National Geographic channels, as well as international assets, the Indian Star channels, 39% of the Sky Television Group, as well as Fox's share in the Hulu platform. Disney swallowed all this up for $71.3 billion in 2019, half of it in cash. In April 2018, the group launched ESPN Plus, a streaming service specialized in sports. Then, in November 2019, its own offering, Disney Plus, with an aggressive pricing policy which would affect the service's profitability for at least 5 years. Then trouble started. The purchase of Fox's assets weighed heavily on performance. In Q3 2019, net income was down 51%. Well below expectations, hampered by losses at 20th CF Studios and lower advertising revenues at the Star Network. Investments made to develop ESPN Plus and Disney Plus also dented profitability. Early 2020, COVID forced the closure of theme parks, movie theaters, cruise lines, and production studios. And Bob Chapek, who headed the Parks and Resorts subsidiary, took over as head of the group, an unsuccessful appointment to say the least. The next 2 years were similar. Disney Plus experienced dazzling subscriber growth, while ESPN suffered a severe downturn in subscriber volume. By 2021, the sports network lost 8 million cable and satellite subscribers, representing 10% of its base and around $1 billion a year in recurring revenues. As the group continued to invest heavily in content, losses from streaming exploded. $1.47 billion in Q3 2022 and $4 billion over the year. To stop the hemorrhaging, the group multiplied broadcasting partnerships, such as with Amazon Fire TV, Apple TV, Roku, or Verizon between 2019 and 2020, and offers streaming plus theme park entry combinations. The latest films are failures, and Hotstar, the streaming version of the Indian subsidiary, is losing lucrative contracts. Things went so badly that in November 2022, the group recalled Bob Iger, who had retired, to the helm. Here come the strategic reversals. Iger decided to raise subscription prices, an announcement that was not well received by users and the markets in a context of inflation, and to propose an ad-supported offer. He announced a reorganization of the group, laying off 7,000 people, and promised that streaming would reach profitability by the end of fiscal 2024. By contractual obligation, this year the group is likely to take full control of Hulu, buying out the 33% it does not own from Comcast. It is working on consolidating its streaming offerings, while planning to invest $30 billion in content over the year, so money has to be found. Disney, which is extending Bob Iger's contract by 2 years to 2026, announced the sale of its ABC, National Geographic, FX, and Freeform TV channels, part of its Indian operations, Disney Plus Hotstar and Star India, and is looking for a strategic partner for ESPN. The group is also grappling with the strike by Hollywood actors and screenwriters, and has suffered from its public conflict with Florida Republican Governor Ron DeSantis over issues related to minorities. It is also gradually losing the rights to mythical characters from the early 20th century, or Walt Disney's original creations such as Winnie the Pooh and Mickey Mouse, which will fall back into the public domain in 2022 and 2024 respectively. This legal risk is likely to increase in the future. So, what's next? Several options. Either Iger revives the magic, restoring the luster of Pixar, Marvel, and Star Wars, and improves the group's performance, or sale options will be considered. And among these, rumors are already swirling about a total buyout by Apple.